Hi, good day. My name's John Kennedy. I'm the Citadel Director for Wealth Planning in the Citadel Group, the team that's responsible for securing new business and bringing new families on board into Citadel. And I think the one thing that we get really well, is that for many people, avoiding any form of loss, particularly around their portfolios, is vitally important. And so what I'd like to share with you in this podcast, and certainly thank you for watching this podcast, is 4 key risks that I think should come up as part of any conversation when it comes to building a portfolio and constructing your own personal asset allocation. I'd like to argue that not any one of these risks is more important than the other, but certainly should come up in their own individual right in creating the blend of asset classes that suit you and meet your objectives over your lifetime. The first is what we're all familiar with and what we're all common with and read about all the time, and that is inflation risk. This risk of prices increasing of what we purchase on a day-to-day basis, and what happens over our lifetime is the purchasing power of our rands, of our dollars, of our euros becomes less and less and less as inflation erodes that purchasing power. It's a simple reason why cash in the bank is not a sustainable long-term strategy for your full investment portfolio, as we're well familiar with that tax on interest earned doesn't beat inflation over time. The second risk is valuation risk, and that is quite simply that what we see in financial markets on a day-to-day basis are prices, where buyers and sellers meet at a price of whatever asset or whatever security we look at. But what's interesting about those prices is that they don't always reflect value. And so what happens when people are overconfident or the market is bullish is that people will be willing to pay 80 cents for something that's worth maybe only 60 cents, that its value, inherent value, is only 60 cents. And similarly, when the market is very negative and bearish for whatever reason and people are worried and the risk-off trade is on, that people will be willing to accept 50 cents for something that's worth 80 cents. It's important to maintain this distinction, and when one looks through an investment portfolio, is to make sure that we don't overpay or certainly undersell when it comes to investment portfolios. What often happens when markets are down or when times are tough is that portfolios become illiquid. And a key risk to avoid any permanent destruction of capital is to make sure that one doesn't become overly illiquid in one's investment portfolio. Because selling out at a loss is an extremely destructive part of one's life. If we find ourselves in an environment where something is priced at 50 cents, but its inherent worth is 70 or 80 cents, and selling out at that point in time, that incurs a permanent loss of capital. The fourth risk I want you to consider and be aware of is credit risk. Now, we read extensively in the papers on a day-to-day basis of the likes of Standard & Poor's, Moody's, Fitch, etc., the rating agencies around the world that are rating governments, rating parastatals, rating corporates, and looking at their financials and giving them a ratings grade. What's important in today's environment, in chasing yield and chasing income, that one doesn't take on board too much credit risk when one looks at portfolio construction. What's important to understand is the solvencies of wherever we are prepared to lend our money to. Credit risk also extends to where you place your capital and making sure that your capital is safeguarded against the institution that's looking after such money, whether it is an asset manager, a bank, or anything along those lines. So credit risk forms a very important part of one's overall portfolio construction. So just to summarize, to avoid any form of permanent loss of capital, to avoid losses, one's got to look at 4 distinct risks and look at one's portfolio and how you mitigate against it. That being what inflation does to my portfolio. That being what my portfolio is priced at and what the intrinsic value of the assets that I'm holding is. That being whether we take on board too much a liquidity risk and how I make sure that I secure my cash flows for whether it's income requirements or capex requirements. And the last being credit risk and making sure that one doesn't take on board too much or excessive credit risk in constructing one's portfolio. I hope this helps. I hope it gives you food for thought. I hope it gives you some key questions to ask your advisors next time you engage with them. Once again, thank you for listening.